All right, welcome everybody to Live Valuation. I'm Midas and today we're going to be taking a look at ticker QCOM, Qualcomm Incorporated. Another company we've definitely covered before on the channel once or twice. Very well-known company, doesn't necessarily need a huge introduction, but regardless, it is a producer of system software for largely mobile applications, though also a large amount of other computing devices, including automotive and other Internet of Things like devices, with their kind of major CDMA technology, as well as licensing their products to other things. Very interested to get into this valuation that we have for them today. Like I said, we have covered them before, so in some ways it's just kind of seeing how they did this year, relatively speaking, seeing how the numbers compare to last time. Here I have our watch list that we've covered for the companies we've covered on the channel herein, which there's definitely been some movements a little bit within, and I've also made a lot of kind of reassessments of different companies, as I kind of talked about in my last stream. Whenever new companies kind of rise up to the top of the watch list, typically what I do before I just immediately go out and start buying them again is I reassess my previous assumptions and think about how they are. And regardless of that, I have been buying Smith & Wesson and Interfor, ones that I've been buying a lot more regularly. Still holding Fidelity National Financial, which there's kind of interesting things to talk about in regards to that, what with their planned share distribution of one of the sections of their business, F&G, which we've discussed a little bit on the channel before, a little bit here and there. It's one of the sections of their business, the annuity selling parts of their business. They're looking to sell about 15% of their ownership into the market, which is slated to happen here within a couple weeks. And so people who own Smith & Wesson shares at whatever the specific exchange rate, I can't remember the numbers off the top of my head right now, wasn't looking to get into that too much today. The point is that's going to be happening in the near future. So anybody who owns that, don't be shocked when the share price does in fact drop, because it will drop when they distribute those shares to you, because you're getting something else instead, effectively speaking. Regardless, I'm actually rather excited for that happening. Anyway, I kind of got a little distracted with that. I had reassessed my positions in Buckle and Hibbett, retailers that I purchased earlier in this year, and both of which have made pretty good profits on this year. There's lots of companies that I'm down on in my portfolio, along with everybody else's portfolios for the most part this year, unless you're in very specific things. But those are some clear winners that we've had in our portfolio. We did trim back our position in Buckle. And then actually I've been considering buying more Hibbett. And then I'm bringing up the fact that I trimmed Buckle because I actually trimmed Buckle right at the same time, right before that I made some other assessments to other portions of my portfolio, at which point I started thinking, you know what, maybe I shouldn't have trimmed as much of Buckle as much, because actually now I see that it's still pretty good. I just kind of trimmed it largely because I was a little bit oversized of the amount that I wanted to have of them. But regardless, I was kind of already yeah, maybe that wasn't necessarily the greatest choice. But the saying, you're never going to go broke taking a profit, obviously a lot of people like to take quick contention with that, because it's like, well, that's not always so clear that just because you're taking a profit, things are the greatest choice for you. Samphire Resources, that's another company that we've owned for a while, which has done pretty poorly for the last 6 to 9 months or so. It had a very nice bump up this week. It is a really low liquid foreign small cap stock and a minor. So really it just takes some relatively small amounts of activity for that one to do pretty exciting things. And as I said, it had performed pretty poorly. So honestly, it was just a little bit of a bounce back, what with the spike in copper prices and other metals in the last week or two, since the Federal Reserve started kind of trimming back their discussions about just how aggressive they're going to be with the interest rates. And the markets have started to take that as a sign that they're going to eventually reverse course. Not necessarily my opinion that that's really what's going to happen, but that is kind of what the market has taken as it is. So anyway, enough discussion of kind of the happenings in the watch list as we've done with here. There's also economic news. Today we got the producer price index numbers, which it did come in a little bit cooler than the consensus 0.04. 40 basis points was expected. We got about 20 basis points compared to the 20 basis points we got last month. And I would say that technically speaking, if you're just paying attention to general market data of commodity prices, then it isn't really a huge surprise what the month-over-month numbers are for the PPI index, because basically those two just track. Really, it's the consumer prices that's a little bit more of a surprise. So I would say this one wasn't really as shocking to me, and the market doesn't seem to be too shocked by it either. Yesterday, what was really surprising was the consumer inflation expectations number, which I didn't actually pull that up here today. But the consumer inflation expectation number came in relatively hotter than it was in the previous month, which expectations is a pretty core component of what actually drives future inflation numbers. In fact, when at the start of the month before the consumer price numbers came out, I did in fact make my own prediction about what I thought the month-over-month consumer price number would be, and I bring that up because one of the core things that I'm using in my own model of how to predict month-over-month inflation numbers is the inflation expectation number. So I use gas prices, inflation expectations, the federal funds rate, rental prices according to Zillow, and the commodity price index, as I was talking about, because you can get live data on the commodity price index rather than relying on the producer price index. My prediction was 40 basis points for the month-over-month change in the consumer price index, and the consensus estimate was 60 basis points. My prediction was 32 basis points. The actual was 40 basis points. My bad. The consensus was 60 basis points. So you can see I was 8 basis points off in my estimate compared to the actual number, whereas the consensus of all the economists out there were 20 basis points off. So I was 12 basis points better. And this is just 1 month. We started running this model. We'll see how I do next time. It could just be a fluke. But the point is consumer expectations is a pretty core component. I wouldn't necessarily think that things are going to start to turn around too dramatically. That said, as far as I can tell with this month, it just still seems like inflation may come down next month because things are still looking a little bit cooler on some of those factors. So with that, we can actually get into Qualcomm specifically. As we often typically do, we'll start with some basic company information. Qualcomm was founded in 1985, and they're in the United States on the they're not on the United States stock exchange. I always do this. I always forget to switch over to the correct exchange that they are in fact on, but that's just something I always forget. That's kind of the default element I have written there on most of my templates. Anyway, on the Nasdaq exchange, United States dollar is the main currency. I have the main websites for them right here. I can see Cristiano Amon is the current CEO. He became CEO about midway through 2021, and he joined in 1995, being part of their QCT division, and also has large experience with Vodafone and other companies from prior to that. So he's a pretty main member of the semiconductor industry. He's also has an engineering background, so it's definitely the type of person that you want at the helm of this type of company if you really want them to have a really forward-facing technological development kind of approach rather than just focusing on the numbers, which is good as being part of the semiconductor industry. Top customers, I only wrote down a couple of them here. Really, there's a pretty wide range of customers for them, but Apple and Samsung, being that those are the major phone makers, are two of the real key players when it comes to thinking about who their customers are, especially considering the licensing nature of their products, the licensing of their software for the phone makers. And obviously, like for example, a couple years back, they had the kind of antitrust court cases going on. What the Apple was kind of driving against them over their products, which they did end up winning those cases. But the point is that's why it's very important to pay attention to those two key players, because obviously those guys have a large amount of leeway when it comes to kind of pushing these kind of legal issues towards Qualcomm. Competitors, kind of in that same vein, Samsung, Huawei, Broadcom, Apple, Intel. Some of the people who are in fact their customers are also technically also competitors against them because they're also producing their own chips, as well as other producers of chips and software applications for phones and mobile applications and other internet of things and automotive devices as well. Suppliers, they are heavily reliant on Taiwan Semiconductors, which is not a super unique thing for the semiconductor industry in general, but that's definitely something important to note. I think I can't remember what it was. I think in the numbers they said it was like 30 to 35% of the manufacturing is reliant on Taiwan Semiconductors. That might be apocryphal. I might be confusing with something else though. Report date, they're expected to be reporting their next numbers on the 2nd of February if things are consistent with the previous quarters. Call coming in presumably on the same date, though not necessarily the filing. Revenue guidance, they do have Q1 revenue guidance of 9.6 billion and other guidance of $2.35 for their non-GAAP EPS, but their non-GAAP EPS is not the same as my non-GAAP EPS, and that's not the same as GAAP EPS, so that's not necessarily too much of a useful guiding factor, but either way, I kind of felt like I was going to include that here. Revenues for the next fiscal year, according to analysts, 40.41 billion according to 27 analysts, and then the year after that 45.28 billion according to 24 analysts. So a little bit of a dip down in revenue in the near term, but then growth starting to take back off thereafter. And then the EPS probably also in line with the non-GAAP adjusted EPS. That's more typically what analysts are providing their own guidance on. And again, this was also for the one singular quarter, it's worth noting. The analysts for the year, though, 1021 according to 25 analysts, and then 1226 according to 22 analysts in the year after that. So growth in the EPS will return as well, presumably, according to these analysts. Trailing 12 months for the dividends, $2.86, and then the forward dividend as of the most recent increase is going to be $3 per share on the year, which equates to 2.38% currently. And then there's also 8.1 billion still authorized in their current buyback authorization, which equates to 5.61%. So between the two of that, you're going to get close to 8% or so on total yield, and they are pretty liberal with the use of buybacks, which we'll definitely get into their shareholder paybacks historically here in a little bit. But so I mean, it's pretty reasonable to assume that they probably would use those buybacks within like a year, maybe 2 at the most. It seems like on their kind of typical trends, maybe 3 at the very most or something like that. And it wouldn't be surprised me to see them authorize a bit more at some point in the near future. Percent of insiders held 0.14%, so relatively minuscule amount of insiders holding, and percent increase in the last 6 months, 11%. So there has been a little bit of an increase in insider holdings, and so you could take that as a relatively good buy sign. Held by institutions 74%, and short outstanding about 1% or so on the float, about the same. Short ratio 1.68%, so no real leverage in the short's hands. They have a very short time frame. 3-month average volume 7.97 million versus the last 10 days it's been a little over 11 million or so, a little bit hotter volumes in the last couple weeks relative to the last few months. So there is a little bit more buying pressure going on. So we'll hop into their numbers a little bit here in a second after taking a quick look at their earnings deck. A few details I want to talk about from that, but I will say before getting into this, if you're watching live or on the replay, please give us a like. Likes help attract more viewers to the channel. It'd be really appreciated if you can give us more likes. And also, if you're new to the channel, if you haven't watched us before, either live or on the replay again, please subscribe to the channel. Subscribing to the channel will give you notifications whenever we go live, as well as whenever we release other videos and content like that. So it'd be really great. Please subscribe so that you can always be here. And also, if you are interested, there is the link in the description, as well as the pinned comment in the chat. There is the link to the Discord, where we discuss daily news, have discussions about what's going on in our own portfolios, discuss our own ideas about various companies, analysis, and the moves of major investors or things like that. So come be part of the discussion there. Always a pretty interesting thing to be a part of throughout the week. So come be a part of any of those things, like the channel, subscribe to the channel, as well as join the Discord. So getting into their earnings deck, only a few things I really kind of want to point out here. Nothing too dramatic, but kind of just talking about the growth that they had over the last year. Very strong. They operate primarily in 3 major segments. I always get the acronyms wrong, so forgive me if I'm going to confuse this in my head. The QCT, the QCT segment is their main operating segment for their CDMA technology, if I'm not confusing those two things. So in many ways, you can kind of think about that as the sort of main segment. As you can sort of see here, they have 32% in total growth of their overall revenues year over year, 47% of their earnings before taxes, and 47% increase in the EPS. And then this is the QCT segment. You can see it grew 39%, and EBT grew 65%. So the main segment of their business, where they're selling their primary technology, grew at a faster clip than their overall revenue growth, which is pretty substantial. That's always what you want to see. They are a very cyclical company. We did talk a lot about a couple other more cyclical companies, like for example Micron, we talked about more recently. They have a very high cyclicality nature to their revenues. That's kind of somewhat true for Qualcomm, because of the fact that their technology and the licensing is super reliant on kind of the mobile phone cycle. So there is a little bit of that going on with the fact that they kind of did get a huge growth in this. There's going to eventually be kind of lapses in those growth periods. And then also you can see here, I got distracted from it. QTL is the next section of their business, the kind of secondary part of their business. So they also have a third main segment, but QTL is the licensing segment. So this is when they're licensing out their technologies to other companies for use, which is like I said, another major part of their business. But this is kind of like the main segment of their primary technologies, where they're selling it much more directly versus licensing out their products for other people. You can see here revenues were flat, and the earnings before taxes were flat. So no real growth there, a little bit of a drag, which is how you get 32% here versus the 39% here. Then across all segments, they also, you can see within the QCT, they break it down by the main segment type. So they have handsets up 49%, RF front end 4%, so a little bit flat there, automotive up 41%, and IoT 37%. So you can see, huge growth in handset, automotive, and IoT. So we'll come down here, taking a look at the guidance they have, also announcing their new Snapdragon technology, that being the main CDMA platform that they use. They have partnerships that they are trying to develop with Meta for the metaverse technologies, as well as Vodafone, and then working in the automotive towards this large TAM in the automotive industry, which, how much of that will materialize, what with the kind of like big market delusion that kind of goes on with the electric automotive space. It's like, yes, we are going to electrify all our vehicles. It's hard to say just how much of that is necessarily going to show up, because it's all of these auto CEOs, tech CEOs that are like talking about these TAM opportunities. So it's like, I don't know, maybe half of that actually shows up. But the point is, there is huge growth opportunities in the automotive space regardless. Anyway, getting into the guidance stuff that I was just trying to scroll down to, but then I was like, oh yeah, well, let's talk about this too. Did I scroll past it? I might have actually scrolled past it. Did I? Maybe I did. Oh, and it did scroll past it. It was actually way up here. I did scroll right past it. Anyway, so looking at the kind of the guidance versus their actual results, which is kind of always interesting to see. You can see the Q4 guidance that they provided. They said that they were going to go between 11 to 11.8 billion. They managed to hit the guidance there. They basically hit the midpoint within their guidance on pretty much all these categories, except for interest and investment, other expense. This one's a little bit over, which is you can see about like 75 million or something, so nothing too dramatic of loss there, and that is quarterly, it's worth noting, so not necessarily the full year numbers. And then they do talk about the their guidance for the Q1, which I had kind of already talked about some of those details earlier. Then they also have only on the annual guidance, the only thing they're providing is the effective tax rate. So with that, we'll actually get into the actual model for the company, coming down to take a look at the segmentation. Being that they're part of the semiconductor space, we will pull open my industry data sets that I have, both for the US and global data sets. For the unlevered beta that they're giving, that they're a US listed company, I am applying the US data set for that. They adjusted unlevered beta in the most recent year for semiconductors, 1.09. So that is what I have on here. For the sales capital ratio, we are going to use the 3-year average for that, and within the US is still the perfect thing to think about, because they're still kind of comparing within those. Those are the kind of similar companies that compete most in line with each other, even though yes, global companies do compete as well, but we'll take a look at global when it comes to sales. Either way, sales capital ratio for the last 3 years on average has been 0.75, which is 75 cents in sales for each dollar of capital invested in business. So that's what we'll have for the average there. And then the adjusted net margin, they also have the adjusted net margin. Oh, actually, I put the wrong number in there. I can see now. The adjusted net margin for the longer term average of kind of 8 years has been 19.5%. I'm not sure why I wrote 23.5 here. I might have copy pasted that from somewhere else, but whatever. 19.5%. You can see relative to their industry, at least in the most recent period, they've kind of more typically had relatively strong sales to capital ratio and relatively strong margins. That has partially to do with their just kind of very strong space in the competitive land space. Which in general, I would say that means that they'd be really well priced for that. They would typically have a really high beta and therefore end up being appropriately priced. So we'll see how that actually lines up for that, and what we'll do with the numbers moving forward. As far as the geographic disbursement of the revenues here. Oh, one other thing I forgot I was going to get into. The revenues. So for the revenues of their industry, which is kind of going to be relevant for our future projections, we'll actually use the global data set, because that's a little bit more relevant to thinking about like the total market share that they actually have. And I actually also have the semiconductor and semiconductor equipment industries in here, which is not necessarily super aligned, but that's can also at least show kind of a more expansive base of like where their total revenues can apply. Obviously, they're a very specific sub segment of this technology, and also you can apply software to them in different ways. So this is kind of apples to oranges in some ways, but the point is you can kind of at least compare the overall chip industry as a whole to the software systems that are related to those chips. So at least they kind of have to grow somewhat in scale to each other. So a little bit kind of an odd way to think about it, but the point is, regardless of that, you can see that currently in total sales there's about 860 billion or so in 2021. And if you work backward based off of the numbers that they had in previous years, you can also find that in 2016, the total same number would have been 470 billion. So going from 470 billion to 690 billion in about a 5-year compounded time frame is basically kind of the growth we've had over the last 5 years. Now coming up here closer to the sales thing, skipping ahead a little bit here, I did kind of put these numbers in here, 470 billion versus 860 billion, and then compared the revenues of Qualcomm in each of those years. So if 5 years ago, their sales relative to the semiconductor space was about 4 to 5%, and now it's a little bit over 5%. So kind of relatively growing in line with each other, and that's going to be kind of how we're going to scale up our revenues in terms of what we expect for them going forward. But regardless of that, like I said, I skipped ahead a little bit. Taking a look at the geographic disbursement of the revenues for the equity risk premium, they have only have about 3% of the revenues for directly being attributable to the US. It has partially to do with the fact that their revenues, like I said, are sold into devices that are then sold in the US. So it's kind of a little bit of an indirect sense. But if you actually look in the total scale of it, about 63-64% of the revenues come from China and Hong Kong. Like I said, a huge reliant on on the chip makers and Huawei and Taiwan Semiconductors. So that's a huge portion of the kind of geographic risk you have to think about for the company. 13 to 14% for Vietnam, 7% in South Korea, 12% global other. So you can see a huge amount of like IoT and automotive devices for the revenues. 40% of their production facilities and longer term assets are in the United States versus about 60% of the rest of the world. So a little bit of a disconnect there. A large amount of their production in the US relative to the actual amount of revenue sold directly in the US. A lot of those revenues do end up in the US, but like 2 or 3 lines down the chain, so to speak. So their cost of equity after leveraging up their unlevered beta to 1.17 with the 10% debt to equity ratio, that gets them to a cost of equity of 11%, which weighting in their market value of their debt, it gets them to a weighted average cost of capital of 10%. And with that, we can take a look at their historic history for the last 10 years. Their historic history, wow. Good word choice there. So you can see in 2012, they went from 24.8 billion or so, 24.9 billion in total revenues up to 44.2 billion in 2021. And as you can see, as I was sort of talking about, there was a little bit of a decline in the revenues for the first 5 years, where it actually bottomed out here in 2016 with 22.2 billion. So there was a little bit of a downward movement, a little bit upward movement in 2013, and then downward into 2016, and then the revenues started to climb up a little bit, though still having a little bit of a down year, and then really it was just 2021 and 2020 and 2021 when the revenue started to take off, which is partially has to do with the huge growth in total money out there for purchasing these types of products, and the types of products that people did actually purchase with the various amounts of stimulus money that was out there. The overall rev cycle, it also kind of moved right at the same time that there was a new phone cycle kind of going in line in place. Not to mention, as I was talking about, there was also the court cases, the legal cases that Qualcomm had to deal with, and those were kind of being finally dealt with at the end of 2019 and into 2020, if I'm remembering the timeline exactly. So basically everything was just kind of like perfectly aligned for 2020 and 2021 for Qualcomm to just have this huge rocketing up in total revenues. And the real question is, like I said, how much further this particular end of the cycle is going to extend, and then also whether or not there's going to be kind of like a leveling off period as we've seen before, or maybe it'll just kind of move into a little bit more of a steady growth as they've kind of diversified into other products. So there's a lot of more kind of question marks about like where the growth will go from here, because obviously we've had 2 huge growth years in the last 2 years, and it's like maybe you can get another really good growth year in this cycle, though it doesn't necessarily have to come immediately. We might have a little bit of a pullback first before you get one more good year, but then at some point or another, it's expected that there would be a sort of a leveling off. And maybe that could be a short-term leveling off. Maybe it has a good growth year for 1 year, and then it kind of levels off for a couple of years, and then it starts to go into a growth cycle again in 2027, 2028, kind of towards the end terminal point of our DCF. So it's kind of multiple ways you can kind of look at it. Now, taking a look at their gross margins throughout this entire time frame, though, so throughout the movements of the growth of their company, for the first 5 years, you can see the average gross margin was 59 to 60%, and for the next 5 years, it was 59%. So there is a pretty a pretty consistent overall movement in the actual gross margin, regardless of the movements in the revenues. You might often, for certain types of companies, see a pretty consistent downtrend in the gross margins when they're having this kind of down movement portion of the cycle. And there is a little bit of that, as you can sort of see here, because like, for example, it does move from like a low point of 54 in 2017 to, let's see, what's the highest? We have 64 to 65 in 2018. But I would also note that those are like literally right after each other, right? So it's like 2017 to 2018, and like, what was the revenue growth between that point frame? 1% in 2017 and 7% in 2018. So it's not like you can necessarily look at that and say, oh, well, that they suddenly had a huge gross margin when they started to move into the up cycle or whatever. And so I wouldn't even necessarily say that the movements of the gross margin overall across this 10-year time frame, even though yes, it seems pretty consistent in the end, I would say that the actual like code movements are kind of random almost seemingly. So anyway, coming down to their reported net margin, see the reported net margin before recapitalizing R&D for the first 5 years, it averaged 22 to 23%. And for the next 5 years, it averaged 14 to 15%. So there is a huge decline in the overall average net margin before adjusting for R&D, though that has partially to do with significant non-operating charges, which has to do partially with some of the legal happenings that they were going on through. So dealing with some kind of odd charges and write-offs through that time frame. You can see 2017, they had a negative 22% margin, and that's a huge outlier, obviously, when you kind of just look at these numbers. Like the average across the entire 10-year time frame is 18 to 19%. If you take out that one negative year, they didn't even have a negative year in 2020, though obviously they were having a really profitable year in 2020. But if you take that out, it jumps up to 23.3%. So that's a huge difference if the outlier can pull down the average like 6% in a 10 number average. That's a pretty strong outlier. So anyway, like I said, though, this is before adjusting for R&D capitalization, which is a process that we like to use pretty consistently on this channel. We believe R&D is a long-term capital expense, not a short-term operating expense, and therefore it should be capitalized, which means you have to amortize it away at a certain extendable life, which we're using a 5-year kind of standard for this particular model, though you could always argue with that and say that maybe 3 years would be appropriate or something like that. It doesn't necessarily change the numbers too dramatically. But anyway, the point of this is when you capitalize R&D, what it does is that it basically gives net income a boost. It gives it a small increase compared to the reported net margins, as long as a company is constantly growing their R&D. If they're doing more R&D year after year than they were compared to what they were previously, then that means that they're going to have a higher net margin than the GAAP margin would report. If they start to have less R&D than previous years, after like 2 or 3 years, they start to have lower net margins than they would have according to GAAP numbers. That's kind of how this process typically works out. So anyway, because of that, though, because it does require 5 years, that means that I can actually only give about 5, maybe 6 years worth of corrected net margin numbers. So we don't really have the full 10 years to compare. But either way, if we take an average of, say, the most recent 6 years of the reported net margin, that becomes 14%, including that 22 negative number. 14%, let's just take that one out and see what that is. That ends up being 21.5% or so. If we capitalize for R&D, including the outlier year, we end up with 17.5%. So as you can see, what I was talking about there, it went from 14% to 17.5% because of the R&D capitalization. And if we come up here to R&D, we can actually take a look at that. As you can see, there is a little bit of a dip down here in 2018, but it's a relatively small dip down comparative to the then double-digit growth in R&D in 2019 and 2021. So that would explain why overall on net you would have an increase on the GAAP net margin according to this process. R&D did in fact go from 4.9 billion in 2012, in fact averaging 5.3 billion for the first 5 years, to then going to 8.2 billion in 2021, or averaging 6.4 to 6.5 billion for the next 5 years. So pretty consistent growth in R&D, even if it has its kind of movements and bumps and whatever over any particular one singular year. But anyway, so taking a look at that, also the reported R&D number, if you take the outlier out, that comes to well, this is the reported one. We already talked about that, 21.5. But the R&D corrected one, if you take that out, becomes 25%. So 21.5%, 25%. Hey, it's the same difference, about 3.5% or so of an increase, apparently, for Qualcomm, just for R&D capitalization. So in my opinion, that's how profitable they truly are if you're kind of removing the numbers around. And what that does is that it also then lowers the cost of the returns on capital, because we aren't taking the R&D and just acting like it didn't happen. We are taking the expense, we're putting it on their balance sheet, and we're eventually going to expense it away through amortization. So it's like we're just refiguring the accounting rules. We're not cheating or anything like that. We're actually correcting the accounting rules. But anyway, the point is so you could say that if you wanted to include that negative number, you could say maybe 17 to 18% is kind of how profitable they've been in the last 5 to 6 years, or maybe you don't want to include that number and say you want to say 25% is how profitable they are. You could make arguments for either one of those cases about that being an outlier here or not. Either way, a very, very profitable company. As we said before, what was it, 18%? I think was the industrial average. That industrial average is including R&D capitalization. That average is including that. So yeah, very, very profitable. You could argue that they're, like I said, if you include that outlier year, they're about as profitable as their industry. If you don't include that profitable outlier year, they're much more profitable than their industry. So coming down to the cash flows, we'll take a look at that. They have had pretty consistent growth cash flows in one form or another. R&D capitalization is one of the major forms that we like to count as R&D as growth cash flows, but obviously there's growth by acquisitions, which is a pretty consistent factor for them. Obviously they've also had capex as well, which kind of is an interesting point where you can see the cyclicality that I'm talking about. Acquisitions can happen in kind of random odd years in different ways. R&D is something that you should be doing year in and year out, but there might be some strange co-movements in it that might not be indicative of some sort of pattern. But capital expenditures typically do move in a pretty consistent pattern. It's you don't start building a plant and then just like stop working on that plant next year. It's you're going to build this plant. It's going to be a 5 to 10 year scale. And then once you build that plant, you're not going to build another plant for 10 years. So there is going to be a natural cyclicality to the way in which capital expenditures, the traditional type of capital expenditures, like actual plants and property and equipment, are going to move and have their expense. So the reason why I point that out is that you can see, for example, we had a $1 billion growth in the capital expenditures here in 2012, 2013, and then well, what do you see here? It starts to drop off pretty significantly. It gets cut pretty low into 500 million or so by 2015, kind of into the lower part of the cycle, as we were kind of seeing. This was actually kind of the lower points in the cycle as we were seeing with the overall revenue growth. So you can see that there is a pretty consistent movement there, and then it starts to take off in 2019, pretty high. 2020, it's growing even higher. 2021, it's reached new peaks. So we'll actually reach new peaks in 2019. But the point is it consistently grows to ever higher peaks, and all that happens at the same time as those revenues are finally starting to take off. So my point is you can sort of see a little bit of a cyclicality baked into specifically the capital expenditure line, which would give to me an indication that this very well might be the actual peak. That's something to keep in mind there, that we are seeing kind of the activity we might have right there. And the reason why that could lead to actual peak profitability is because, again, we have to think in terms of EPS. When you do a capital expenditure, it doesn't hit your profitability because of the fact that you're capitalizing that item. See, like we were talking about R&D capitalization earlier, let's talk about normal capitalization, like property, plant, and equipment. When you buy a property, plant, and equipment, it doesn't come out of your earnings because you put it on your balance sheet. But because you put it on your balance sheet, you've now increased your future expenses. You've increased your future amortization expenses. And most people say, oh, well, that's a non-cash charge. And it's like, well, yeah, because you didn't pay cash for the plant. So it's like you can't act like plant is a non-cash charge and then also act like the amortization is a non-cash charge. You have to pick one of those to act like it isn't real, right? It's like either you're using earnings or you're using cash flows. If you're using cash flows, well, then you would say that 2020 and 2021 were actually not super profitable years relative to what they might otherwise have been if you weren't paying for all these capital expenses. But if you were using earnings, you would say 2020 and 2021 is a super profitable year. And to kind of make my point with this, I would say, look at this. Free cash flow to equity is in fact a negative number in 2021 versus we have 15 billion record profits in 2021 according to the corrected EPS. Oh, that's my corrected EPS. But if we use GAAP EPS, 13 billion. So whatever, 13 billion. And then you could say, compare that 2020, 9 billion for the EPS. They did in fact have 6 billion for free cash flows to equity here. But if they didn't do 1.3 billion in acquisitions or have 1.8 billion in capex, that means that this number could have actually been more like 9 billion, which would have been closer to the EPS earnings numbers. So that's the point. Is like people often look at earnings or cash flows when it and they kind of switch to the other, talking about the other one whenever it's convenient for them. But as I was kind of starting with this conversation, the point is that we have really, really high cash flow expenditures here, which might be indicative of lower EPS earnings in the future because of the fact that amortization is going to grow because of the fact you did the capital expenditures. So anyway, kind of distracting with that. It's actually very, very good that they're doing all of these, these growth expenditures. So it's not a bad thing. It's going to lead to higher revenues in the future. But the point is as the revenues grow, their earnings kind of relative to those revenues tend to shrink initially, and then they start to springboard up later. That's how cyclicality works. Is you're kind of building in this operational leverage, and then eventually that leverage springboards into later profitability. That's the reason why it's like we had higher profitability right now. It's gonna eventually kind of kick back down and then back up. So the question, like as I kind of said when I was talking about the revenues, is where we are in the cycle. So anyway, taking a look at overall all of this, we can let's take a look at the different types of movements in expenditures, the capital expenditures. We have obviously the capex. Overall, the 10-year time frame, the average is 1.1 billion. So really 1.1 billion over the 10-year time frame. Anytime it's over 1.1 billion is the point where you could say that it was a year above average. And in fact, if we're going by that yardstick, these are the years in which they were above average: 2013, 2019, 2020, 2021. So hard to argue that. Okay, but 1.1 billion acquisitions. They have pretty consistently been doing acquisitions over the 10-year time frame. The average acquisition per year is 1.3 billion. So actually more than the capital expenditures. That seems to be a reliant factor for them. Also, if you take a look at that, what are the years in which they seem to be having peak levels of acquisitions? Well, 2014, 2016, 2020, 2021. Not quite as well lined up for 2014, 2016 with the other, but 2020, 2021 is looking like a pretty hot year. Then there is obviously change working capital cash flows. That is a part of capital expenditures too, but depending on the type of company in the industry, it might be minuscule. For them, it's actually been on average negative 800 million. So we don't necessarily need to think about this one as dramatically, but still negative 800 million. If you think about the ones that are in fact higher than that, it's it's a negative number. So you have to think about it in reverse of that. Well, there is in fact going to be that, but as you can see, there isn't as consistent of a pattern of it because it's working capital. If this was like a retailer, that might be a major form of their capital expenditures. But coming up, we can also take a look at the R&D expense, as we had talked about. That one isn't as fair to use the same way because it's gonna grow on its own consistent basis. But 5.8 billion, we can still take a look at that. 5.8 billion. All of the highest levels of growth have been in the last 3 years. So yeah, the last 3 years, no matter how you spell it, no matter what section of capital growth that they have been paying for, that's just been the year. 2019, 2020, 2021, they've been paying for growth. And that growth presumably will show up in 25, 26, 27. But the question is whether or not profitability reaches it by that point. Now, they've also done a decent amount of debt issuance over this time frame as well, and that has to be discussed. We got these really, really large issuances of debt back here in 2014, 2016. You can see for the first 5 years, on average, they issued 5.3 to 5.4 billion per year in debt. That's a huge amount of debt to be issuing. Like, for example, looking at their net income, we won't look at the corrected since I can't give you super accurate numbers for that. But for their income was 5.6 billion. So they made 5.6 billion per year for those 5 years, and then they were also issuing basically that much in debt at the same time. That is a huge amount of debt to be issuing. For the next 5 years, they've actually been paying down about 900 per year, though most of that actually was being paid down in 2017, as you can see here. They issued 10 to 11 billion, and then they paid down 5 billion in 2017. So in some ways, you could say that it's maybe not fair to actually treat this 10 billion as part of that for that reason, because it's kind of somewhat of a leveling out. But regardless, over the 10-year time frame, it averages 2.2 billion per year. So still significant amounts of cash flows being being issued. And that's cash flows that can be paid out. Debt issuance is something that can be paid out to shareholders. So for a free cash flow to equity number, you actually include debt issuance as part of the number because it's something that can be paid out. But just like with the capital expenditures we were talking about, it's like when you make capital expenditures now, you're increasing your amortization expenses later. You issue debt now, you're increasing your interest expenses later. You're also increasing your eventual debt paydowns later, which means you're decreasing future cash flows. You're increasing current cash flows when you issue debt, but you're decreasing future cash flows. That's how it works. And the question is whether or not the leverage effect gets you what you want enough to pay for it or not. But anyway, over that 10-year time frame, like I said, 2.2 billion. To comparing that, we have the free cash flows to equity. Free cash flows to equity for the first 5 years was 9.4 billion. But again, 9.4 billion when they were actually taking out 5.4 billion per year. So really, they only had like 5 or 4.5 billion or something that they could have paid out to shareholders, not counting the debt. Which is a real free cash flow number. But yeah, so counting the debt, 9 billion or so. And then for the next 5-year period, we ended up with 2.1 billion. So they went from free cash flows to equity of 9.4 billion per year to 2.1 billion per year. And again, this is the cash flows that can be paid out to the shareholder. For the whole 10-year time frame, it ended up being 5.8 billion. And look at the amount of money that they've been paying out to shareholders. They've been paying out significant dividends. They're a pretty significant dividend payer, plus significant amounts of share buybacks. They made those huge cash flow issuances, and they made huge share buybacks in the next year, and that's worth noting. So for the first 5-year period, the total common payout ended up being 7 billion per year. 7 billion per year when they could have paid out, as we said, 9.4 billion. So they didn't overpay for the first 5-year period, but they were also issuing that much debt. So they were only able to pay 7 billion out because they were issuing that much debt. And then for the next 5-year period, as we said, they only had 2.1 billion that they could have paid out to the shareholders because they had to pay down some of their debt. And they continued to pay out to the shareholders 9.8 billion per year. Though, like I said, the huge portion of it came in 2017. But whatever, 9.8 billion per year. 9.8 billion per year compared to, again, 2.1 that they could have paid out. So huge overpayment to the shareholders for the last 10 years. For the whole 10-year time frame, it ends up being 8.4 that they could have paid out, and 5.8 that they did pay out. So they overpaid, what is that, 2.6 billion per year for 10 years straight. 10 years straight. That's $26 billion that they've overpaid to their shareholders for the last 10 years. And, I don't have the 10 years prior to that. Maybe they didn't pay out anything to their shareholders, and they really could have paid out they could afford it based off of the assets they had. So I don't know. We'll take a look at their balance sheet here in a second. You can see their market cap went from 115 billion to 137 billion. So it's like, even though the share price has increased pretty significantly, the market cap hasn't necessarily increased that dramatically, which is, partially those share buybacks. We went from 1.7 billion shares to 1.1 billion or so now. So yeah, pretty significant decrease in shares, about a third of their shares being bought up. But yeah, the question is where does that cash come from? It's like, did they eat up a bunch of assets on their balance sheet, or are they eating their future profits? That's the next real question. Coming down to the returns on invested capital, you can see returns on invested capital very strong. This does include the R&D capitalization though, so we can really only look at the most 6 or so years to get a particularly accurate number. For that time frame, it ended up being 14% as an average. That does include that major outlier of a number there, so that maybe if we kind of take out the outlier, it jumps up to 21%. Over the 9-year period, which does include some of those years that don't have accurate numbers, it kind of ends up being 18-19%. Regardless, if you want to think about it, in the most recent year, it was 29%. Huge returns on invested capital. That partially comes from the kind of very strong competitive position they have, near monopolistic power, enough so that they've been taken to court over it, though obviously legally they were said to not be in violation of antitrust. So that is what it is, I guess, legally speaking. And then how does that relate for them in total returns and equity terms? Again, looking at the most recent 6 years, average being 15 to 16% versus, what was it, 11%? I think it was 14%, my bad. So not a huge increase on the return on equity in the last 6 years. That probably has partially to do with this huge negative outlier year in 2017. If we decrease that, it then jumps up to 38 to 39%, which would be a significant increase compared to that. So as you can see, I guess whenever they have a negatively bad year, I guess it hit them in the return on equity even worse than it does help them in the good years. So coming down to the balance sheet, we'll take a look at that and see the criticisms we were talking about in terms of the cash flows, whether or not that those overpayments have actually shown up here or not. I actually can't even remember. It was like a few days since I actually was looking at the balance sheet, so I can't even fully remember. I've already looked at other companies that kind of can't quite remember the exact ratios, what it ended up being, but what it was. Cash flows for the cash on hand for the first 5 years on average, it was 12.5 billion or so, though obviously you see it was really more like in the single billions for the first 5 years or first 4 years, and then they had the 35 billion on hand in 2016, which had to do with partially the acquisitions that they were doing, the share buybacks they were doing, and kind of the movements and assets going on in that time frame. But for the next 5 years, it averaged 8 billion or so. So comparing that to the not including that particular year included, you would say that on hand the total amount of cash has increased, but that's actually come down to about 2.7 billion in 2021. So not a huge amount of cash that they have on hand, relatively record low actually in terms of cash on hand. They do have securities as well, 3.6 billion or so. So if you're including those, it kind of paints the picture a little bit better, though it still doesn't really improve it in terms of comparative to history. So you don't necessarily want to have a huge amount of cash in hand. It kind of depends on the company. So if they're putting the capital to work, then that's fine. And I mean, hell, technically we were just looking at the returns on invested capital. With those types of returns on invested capital, I guess you wouldn't necessarily want to have cash on hand. So I don't know. But again, we'll take a look at the rest of the balance sheet. Receivables for the first 5 years, on average, they had receivables of 2.4 billion, 2.5 billion, and that's increased to an average of 3.7 billion or so for the next 5 years, and then ended at 5.6 billion. If we come down to the liabilities to look at the payables, we compare that to the payables for the first 5 years of 1.8 billion. So more receivables and payables, what we like to see. And then 2.9, about 3 billion or so for payables for the next 5 years. So still a pretty good increase on that, not as much wiggle room. And then 4.4 billion versus the 5.6 billion, that's actually a little bit more wiggle room. So in the most recent year, it actually, in terms of payables versus receivables, they're actually at a better point now than they've been in the last 10 years in general, I would say. Inventories, this is kind of the spooky question that we've talked about for a lot of our valuations. Inventories have gone from 1.3 billion in 2012 up to 6.3 billion in 2021. So that's a huge increase in overall inventories. What is that? Over a 4x, 4.5x or something like that. Pretty significant. Growth in inventories for the 5-year average for the first 5 years, it was 1.5 to 1.6 billion, and then it was about 3 billion or so for the next 5-year average. So if you kind of think of it in terms of averages, it's not necessarily as quick, it's doubled. And then you could say that, well, actually, there's just then also been this really sharp doubling in inventories in 2021. And that's off of the back of them doubling their inventories in 2020 and then growing their inventories by 85% in 2019. So going from 1.4 billion in inventories in 2018, which is barely over the inventories of 2012, to then up to 6.3 billion, which is just insane. But again, keep that in the context of the growth of the revenues that they had. In 2018, they had revenues of 24 billion. And so you could say that they had inventories of 1.4 billion versus 24 billion in revenues. That's like, what is that? 2 to 3% of your revenues you're holding as inventories versus now 44 billion in revenues. And then the amount of inventories they're holding is 6.3 billion, which is, what is that fraction? 10, 12% or something? I don't know. I'm probably off on my percentages there, but the point is huge, significant scale of difference. That's the point there. So yes, this is a huge, sharp increase in inventories. And in a lot of our valuations, we've been very critical and very cautionary when it comes to pointing out how sharp companies have been growing their inventories. But for Qualcomm, that might not actually be the worst thing. It might be that they had shrunken their inventories because of their problems and the uncertainties surrounding their growth for the future. And so this is them playing catch up to a certain extent. It's still a concern. I would still keep my eye on that. But it could be more catch up than is arguable for other companies. So anyway, taking a look at the overall current assets for the first 5-year period, it averaged 26.1 billion versus the average of 18.7 billion in the next 5 years. So again, that's taking into the context of the 35 billion that they had on hand in 2016. So a little bit of a weirdness there. But anyway, just kind of taking a look at that comparative to the overall current liabilities. 26.1 billion was the average for the first 5-year period. And then the current liabilities was 7.1 billion. So very strong current assets overall, although obviously the cash makes a big outlier on that. 10.5 billion for the next 5 years versus 11.8 in the most recent year period. That 10.5 compares to the average of 18.6, 18.7. So still very strong current assets versus current liabilities, even when they don't have 35 billion in cash on hand. But then 20.7 billion versus now 11.86 billion. So now it's very strong. They got a current ratio of like 2 or so. It's not quite 2, but it's like 1.9 or something like that. Very strong current ratio overall. So in terms of overall short-term liquidity, I would say that's very good. Coming down to the longer-term liabilities, now they have grown their debt pretty significantly. They didn't actually have debt in 2012 to 2013 other than just some short-term liabilities, I believe. But now going up to 2014 up to 9.9 billion, and then that's grown up to 14 billion in the most recent year period. That brings their total liabilities of 31 billion. 31 billion versus 49 billion assets. So very strong overall balance sheet. As I said, 14 billion though is a decent amount of debt, 14 billion, comparing that to their revenues, 44 billion in total revenues. In the most recent year period, they had 12.9 in GAAP net income. So, if you're thinking about it in terms like that, you're like, well, if we had one very, very profitable year like the one that we had this year, they could pay down the vast majority of their debt. So, I mean, it's a decent chunk of debt, but it's not necessarily a huge problem per se. And if you compare it to the market cap, it becomes even of a smaller problem. Obviously, they have currently a market cap of 144 billion. So that's like 10% of their market cap, as we saw when we were looking at their discount rate. So anyway, I kind of skipped past the equity statement. Looking at their equity statement, we can see some good and some bad is what I would say here. Firstly, let's just take a look at the overall number. Total shareholders equity went from 26.2 billion down to 18 billion in 2021. Now, for the first 5-year period, it averaged 31.2 billion. So it did kind of grow for a year or two. Well, actually, it kind of peaked here in the next year or so, and then it came down. It had partially to do with the write-offs and acquisitions and changeovers in their assets that we talked about, which gave them the 35 billion they had on hand. Also had their really bad negative profitability year in 2017, which is part of the reason we were arguing that it was maybe an outlier. They had a huge changeover in their business. You can see right here, retained earnings dropped from 30 billion to 500 million, and the overall shareholders equity went from 30.7 billion to 800 million. So yeah, huge changeover in the overall business structure when this happened. That's partially what happens when you do have that type of situation happen in your overall structure of your business, and that made their equity disappear basically. Now, as I was being critical of the fact that they were doing massive amounts of share buybacks, what I would point out is that they've managed to grow their retained earnings since then, even though they've continued to do massive buybacks in this time frame. Their shareholders equity has gone down over this 10-year time frame, and the retained earnings has gone down, which generally means I'm very, very critical of the fact that you're doing massive amounts of buybacks. But it looks to me like you really were in some ways using those share buybacks as a form of reorganization of your business, which is something that people talk about all the time. It's like, if you're issuing debt and using debt to buy back your shares, well, what you're effectively doing is you're changing the overall capital structure of your business. You're basically just changing out equity for debt and increasing the overall leverage of your business. And as it's shown here, the overall leverage of their business isn't actually necessarily a problem. In fact, you could argue that they aren't levered enough, depending on what you're looking at. So while it is, like I said, a huge amount of cash that left the business in ways that I would say is too much, and you could argue that it's not necessarily a problem if you think of it as more like a reorganization terms. Now, that's one argument for saying that it's not a problem that they've overpaid their shareholders. The problem with that is that it seems like they're interested in continuing to overpay their shareholders. If I had seen that they had a 10-year average of overpaying their shareholders, but found that in the last 2 or 3 years they had kind of changed that attitude and were now paying within the realm of what they could pay, then I wouldn't necessarily have that problem. But we already looked at the 5-year average. 4-year average is 3.5 billion, and the amount that they paid out to the shareholders was 5.8 billion. 3-year average is 2.9 billion, and then the amount that they paid out to the shareholders was 6.2 billion. And then it includes this negative cash flow year. I don't know. Let's just look at just these 3 years. 3 years here, 4.9. That's 5 billion. And then the average they paid out to the shareholders was 5.5 billion. It's like, man, I'm really reaching to try and make room to argue that they're not overpaying their shareholders, and I still find that they're overpaying their shareholders. So it's like, well, if it was just isolated to, like I said, between 2015 through 2019, when they were kind of dealing with those problems and reorganizing their business, I would say, okay, fine, they're not overpaying their shareholders. In fact, it shows it in their equity statement that they bottomed out their equity in 2017, and then they've grown since then. So what I would say is I would put them on watch. It looks like their shareholders equities is growing now, but it'll eventually have to come down, in my opinion. And that point will probably come whenever they have to pay back significant debt cash flows, and they may not have excess free cash flows to do share buybacks at the same time. So it looks to me like they are in fact overpaying the shareholders, at least just because it seems to be a habit for them. That might be the case. It might just be that we did it so much, we did it for 5 to 6 years straight, and now we can't, in 2019, 2020, 2021, stop doing the share buybacks. And think of it in this way. It's like, how do you explain to the shareholders? You're like, wow, we are now reaching record profitable years in 2019, 2020, 2021. And now we're going to cut our buyback program. Shareholders would lose their minds. They'd be like, wait, what? We're having our most profitable years and we're having huge cash flows and you guys aren't paying them out to the shareholders? And it's like, well, we actually don't have that huge of cash flows. We've been issuing debt. So at some point or another, we have to face that fact. So that's what I would say about that. It's like great company. They're not over levered. So the fact that they've been issuing debt to do these share buybacks is not a problem, but they've been front running them for a while, for a very, very long while. And I don't think that can be kept up for forever. So anyway, moving on from that kind of topic though, we will take a look at their sales to capital ratio, which is our kind of gauge of capital efficiency. In terms of sales versus overall invested capital. I like to think of this as how much for each dollar of capital invested in the business, how many dollars of revenue do you get back as your overall revenue base to then take for profitability. And for them, you can see right here, it's kind of moved a little bit up and down. We have kind of at a low point, gets close to about 50 cents of revenue for each dollar of capital invested in the business. At a high point, it gets a little bit over $1. So for the first 5 years, it averaged about 66 cents for each dollar of capital invested in the business. And then for the next 5 years, it's averaged about 89 cents. So a little bit of increase for the next 5 years or so. You can kind of somewhat track this onto the discussion about where they are in the cycle, but it kind of comes in a little bit of an unintuitive way, which is to say, as we were kind of saying before, the tendency for them seems to be to do the large amounts of investment when they're at the high points of the cycle, which means they're actually going to be increasing their capital base as that happens. And so you see, actually, it seems to show a somewhat lower point of the sales capital ratio relative to where they were before that. It's a little bit of a throw off because we also get this changeover in the structure of their business in 2016 and 2017, which is why it goes from 0.66 to 1.04 to a huge overall drop off in the total capital base, with the retained earnings disappearing, but the revenues didn't drop that dramatically. So basically you get the sales capital ratio shooting up to this point. So you could argue that basically maybe these points here were actually artificially depressed as a result of that. But in some ways, it almost looks like the higher sales capital ratio comes in kind of these mid years when they were at the lower points of the cycle. It's like I said, it's a little bit tricky to see because you end up having kind of two, almost like looking at two sections of the business between 2016 and 2017. But anyway, so with that, I will kind of rely more on like the most recent 3-year average, which gets us a gauge of like how the industry is currently investing. And the industry is currently investing. For them, they did 82 cents for each dollar invested in the business. And as we had said, the industry for the last 3 years on average was 75. So overall, for the last 3 years on average, they've had a relatively high capital efficiency, comparatively speaking. And we'd already talked about their net margins. The average net margin for the industry was 19.5%, including R&D capitalization. And we had said that if you include their outlier year, they're about in line with their industry, maybe a little bit worse than their industry, because I think it was like 18%. And if you don't include the outlier year, you actually think of it as an actual outlier, then their profitability, I think it was like 24%. So you can definitely think of them as much more profitable and much more capital efficient than their overall industry, which in general is not something that lasts for a super long period of time unless you have a very strong quasi-monopolistic competitive position. Usually attracts more capital into the industry until eventually your profits disappear. And again, as we already talked about, they've been brought to court over their competitive practices. So that's a sign that some people definitely think that they should be cut down in size, so to speak. So anyway, we'll get into our actual future projections for the valuation. Before I get into this, I will say once again, if you're watching now, either live or on the replay, please give us a like. It's very, very appreciated. It's the one way you can essentially pay me for my content. More likes helps attract more viewers to the channel, and we really want to get more viewers to the channel. And also more subscribers. We've hit a little bit of a lull in the growth of our subscribers. So please, if you're watching now live or on the replay, please subscribe to the channel. That way you get notifications whenever I go live or whenever I release other content. And also the pinned comment in the chat and also in the description below is a link to the Discord. Come and join the Discord. Be part of the discussions we have there about company analysis, various things going on in the market, and discussions of our own portfolios and things like that. So come be part of the discussion there. So getting into our projections for Qualcomm, as I had kind of talked about with the global data industry set, I had shown the growth of kind of comparative chip industry relative to Qualcomm over the last 5 years. The overall chip industry went from about 470 billion to 860 billion. over the time frame, and comparing Qualcomm's revenues relative to that as 4 to 5%, and then that's grown to just over 5% over the time frame. And like I said, it's not necessarily market share because this is a little bit apples and oranges. It's more of just like a comparative basis for the chip industry, because their software licensing is heavily reliant on that chip space. So regardless of whether or not it's a apples to oranges market share thought process, because they are somewhat in a market of their own, so it's kind of a weird thing to try to compare them to too many other people, to apples to apples. But whatever, the point is it's remarkably consistent. That's kind of what I want to show here. Is like, yes, they grew a little bit in this overall share, but it's pretty consistent. Basically saying that their growth is basically in line with the chip space growth. And that's because chips are pretty broad, including not just phones, but obviously all the Internet of Things and also the automotive space. But so yeah, the point is here we go. We have that kind of growth space. Now also those same industry spaces have grown at clips over the last 3, 5, or 8 year period, different growth rates of averaging anywhere from a compounded rate of 8% to 16%, depending on kind of which time frame we are looking at, or which subset of the industry you're looking at, or whether or not you're looking at the United States as well. Kind of just taking a look at basically all of these compounded rates over different time frames. And I was like, well, what's the highest, what's the lowest? So what's kind of some compounded periods in which they could possibly grow? I said 8 to 16%. We're just going to use that as kind of our barriers. It's a pretty rough estimate. So with that, the best case scenario, chip industry maybe ends up at about $2 trillion or something. I've actually seen that number reported in a variety of locations. I do think 15 to 16% is a highly reported growth rate for the chip industry. I also think it's pretty optimistic. So that's just me thinking pretty optimistically, or being more pessimistic about people's generally optimistic thoughts. And then I think 8%, half of that is pretty reasonable for a lower barrier. So maybe 1.3 to 1.4 trillion for the overall chip space. If you take basically the same market shares in line with that as they're currently at, I'm just going to go ahead and assume their current revenues with that gets you to 70 billion, or possibly 1.7 to 1.8 billion, or 107 to 108 billion as a wider range estimate for that. So, and then I kind of just was thinking a little bit more broadly about that. It's like, well, in a worst case scenario, what if they ended up with a much lower ratio compared to the chip industry as it grew? What if they managed to actually not really grow too dramatically? What if some other court cases happen in the EU or in the United States? Apple brings some more cases against them or something, I don't know, that makes it so that they don't have that competitive space anymore. Maybe they have half as much. So I was like, okay, 70 billion is kind of our lower bar estimate here. Maybe I could assume that they have a significant ratio less than that. Half as much would be 35 billion. I liked a nice round number of 5 that actually got me 43 billion. I was like, fine, maybe a little bit higher than 35 billion. So 5% is my lower bar estimate for revenue growth. It's a little bit crude, it's a little bit rough, but it just is what it is. Now I went with 25% because that's relatively close to the 107. And like I said, I like nice round 5 numbers, I guess. 30 billion. 30% made it much higher than that. So I was just like, fine, 5 to 25%. That's going to be the range of revenue estimates for me for Qualcomm. I decided to lean it towards 20% because I do think that they'll probably get a little bit closer to the upper bounds of that. Like I said, a lot of people report that a $2 trillion chip industry in 2027 or whatever. That's a pretty common headline. I think it's pretty optimistic, but maybe it's not that optimistic. So I'll lean a little bit more towards the upper bound estimates. Now it's worth noting this gets me an expected revenue of 72 billion. That is with these this distribution of probabilities for those outcomes. I do have most of the outcome weighted into the middle, and I have a little bit more lean towards the optimistic outcomes than towards the pessimistic outcomes, but not a very significant lean. And that gets me the expected revenue of 71 to 72 billion. That's worth noting. That's only just a little bit over the kind of lower bar estimate. Like I said, I want to include probabilities that include much higher revenue growth rate to assume that maybe this is actually right at not that high in the cycle. It's like maybe we're about to take off. Maybe the revenues are going to take off and have a much higher level point of the cycle. But I just don't necessarily buy that. I don't know. I think that we already saw a huge up boom in the cycle through 2020, 2021, as we showed with the kind of how the numbers played out for them in 2019, 2020, 2021. I think maybe, and for example, the analysts are projecting 40 billion for this next year. So the analysts themselves are projecting a downward year, which I have simulated here down to 39 billion a little bit. But then they're assuming that they're going to bounce back up to 45 billion after that, which I've kind of basically have happening. I basically I'm agreeing with the analysts as far as the next 2 years go, for the most part. But the question is well, okay, that assumes that they have a dip in 2023, and then they go back to roughly around where they are in 2021, give or take $1 billion. They might increase it by a little bit more. The question is okay, does that put them back into the lull part of the cycle, and then maybe they reach the boom part again here? Or is this boom for another year and then lull? You know, it's like, it's hard to say. It's hard to say. So I don't know. My expected revenue ends up at 72 billion. Their most recent year, the one they just ended, is 44 billion. That's pretty significant revenue growth, especially considering all the macro concerns that exist currently. I have simulated those macro concerns basically just in line with the analysts. I'm just going to rely on the analysts' assumptions for the next year, assume that they're paying attention to that stuff better than I can. And then, like I said, just kind of think this conceptually about the longer term, about what I think for them. 72 billion expected, 43 billion worst case scenario, but 103 billion best case scenario. That's the thing. It's like, do I think 43 billion is just as equally likely as 103 billion? That's kind of the way I like to think about this. It's like, I'm going to weight each of them at 5% of a chance. The question is, do I actually think each of them have the same 5%? That's kind of the argument. I think 43 billion is not very likely. Not very likely, in my opinion, that Qualcomm has less revenues than they have now. But I don't think it's super likely that they managed to double and a half in a 5-year period either. So yeah, 5% chance for each of those. I think that's pretty reasonable. But about 100% chance that they get to 72 billion. I feel more comfortable with that than I do with either of those. So yeah, okay, I'm okay with this range. It's a pretty wide range, but I think that there's a pretty realistic, pretty realistically large amount of uncertainty when it comes to Qualcomm's numbers. So with that, we'll move down to profitability. Profitability is yet another pretty wide, uncertain question. Their profitability has, as we talked about, it's actually pretty strong, even through some of their kind of downward years, though it does have its ebbs and flows, just generally from pretty good to super strong. That's the thing, is that they don't really have bad profitability in any of these years other than the outlier negative year, because beyond this negative year, their worst profitability was 17 to 18%. Or 16%, my bad, I missed that one. And many industries would kill for that in their best year. So saying 16% is bad profitability is a little bit of a joke. So the point is yeah, they're very profitable, but for a number of reasons, as we've kind of already discussed, you could argue that they're going to be less profitable in the future. One, scale. Scale just makes people less profitable over time. Two, legal concerns. There could be future court cases to argue that they're anti fair practice or whatever, anti-competitive, yada yada. Also, the capital expenditures, as we talked about, they already did massive capital expenditures, which is going to increase amortization in the future. So that's just a natural lessened level of profitability. Then there's the question about where they are in the cycle, as we already talked about. If they're going to go to a lower point in the cycle, they're going to end up having lower levels of the profitability. So there's a variety of reasons to believe that they're going to be less profitable in the future than they've been in the last 5 to 6 years. So 17.5% if you include the negative outlier year. 25% if you don't include that outlier year. I'm projecting on net to 22%, and how I get there is going down to 5% in the worst case scenario, 35% in the best case scenario. It's pretty wide. I basically just chose 35% because it's about where they're currently at. I think this is basically the top of the profitability they could possibly have, but hey, they're currently already there, so might as well include that as the top bound estimate. And then the question is kind of similar with the revenue thing. What do I think is equally likely as 35%? I think it's basically almost no chance that they still have 35% profitability in 5 years. I think this is definitely a fluke year or two that will eventually kind of move backward. And you might be like, oh, well, they had higher profitability in other years previously too. Sort of. Again, they're scaling up, and there's already lots of legal concerns. I think this is kind of the upper bound of it. So 5% is kind of got me this midpoint of 20%. So that's part of the reason I chose that, is it kind of gets me a midpoint of 20%. I lean towards 25%. That gets me an expected value of 22%. 22% is kind of in line with the non-outlier included profitability we saw. We saw 25%, so going from 25% down to 22%, I think is pretty fair, and that's not including the outlier. So it's kind of thinking about longer term profitability. I think 25% on average down to 22% is pretty reasonable. In the short term, I'm using the 5-year average without taking out the outlier. I'm not adjusting it any further than that because, well, I think that's a pretty significant hit anyway to assume they're going to go from 35% down to 17% when I'm already including a simulated decline in their revenues in the short term anyway. So that's going to make their EPS drop pretty dramatically anyway, down to an unexpected basis in the next year, about 628, which the analysts were projecting for their own adjusted EPS number. Again, it's a different adjustment, so it's a little bit apples and oranges, but their own adjusted EPS number was $10.21. So I'm definitely below the analyst estimates for that, which makes me feel comfortable. And then in the longer term, it ends up more like 13 to 96%, which is actually relatively close to their most recent year in corrected EPS. So basically, I'm assuming effectively that they're just going to kind of retake that point in the long term, is essentially what my projections give. So that's the assumptions for the margins for the capital efficiency for sales capital ratio. As I kind of said, they currently have about 0.85 for the last 3 years. It's 0.82. Their industry gets about 0.75. They've had higher than 1 in the past, but they've also had down to 0.5 or so. I'm kind of just chose that as my range, 0.5 to 1. That gets me a midpoint of 0.75, which is the industry. I left the industry as kind of the lean because of the fact that they already have a relatively high sales compared to their capital base. That as you carry it through the 5 years, they actually end up with an expected value of 0.92 regardless of the range. So it seems to like that's pretty in line with it. And also considering they'll probably do some buybacks, that seems, regardless of my cautions against it, that seems like a pretty reasonable expectation to have. It does give them a little bit of a better, I guess, benefit of the doubt than I typically would like to give for a lot of companies, because that means in 5 years time, we're giving them both a sales capital ratio and profitability that is still higher than their industrial average. Even though I typically don't like to have both of those higher than the industrial average, but both of them are just currently already so much higher than their industrial average that it's hard to actually force the numbers down that much without it kind of seeming silly, the being over conservative in your estimates towards Qualcomm. It would just be unfair. So anyway, yeah, that is what it is. 22% as expected value for the profitability, with about maybe 90 cents on the dollar for capital efficiency. And then I do have their current debt to equity ratio is about 10 to 11%. I have a range of 0 to 30%, leaning towards 15%, which gets me about, what was it, 14% or so, 15%, which is pretty well in line, and honestly, with just getting their market cap adjusted from the current value. So with that, that's all the assumptions that goes into our value. We can kind of come over to our final summary page to give the final summary of it. If you're watching at this point, either live or on the replay, please give us a like. Liking helps attract more viewers to the stream, and it would be very, very appreciated. That's pretty much the number one way that you can show your appreciation and pay for the stream. Also, if you are not subscribed to the channel, please subscribe to the channel. That way you get notifications whenever I go live or whenever I release other content on the channel as well. And join the Discord. The link is in the description below or in the pinned comment in the chat. You can come and join there where we discuss details related to our portfolios, analysis of various companies, discussions of what's going on in the market, and things like that. So come be part of the discussion there below. So Qualcomm, QCOM, very, very interesting company. Always very excited to update the valuation for that one in the watch list. 10-year treasury is currently selling for 3.88%. Pretty interesting to see that has retraced that much far back at this point. The market is definitely starting to price in expectations of a Fed pivot. I think it might be a little bit ahead of time, but at the same time, maybe not. Maybe they're going to start I do think it's very, very likely that they are going to slow down at a minimum their pace of increase, but whether or not they're going to reverse course, I'm not so sure about that. But regardless, the market went from, what was it, 4.25% or so down to 3.88% so fast. That was a bit sharp. But anyway, I digress. A little bit of instruction on that one. Equity market risk premium for mature markets, 5.26% as I calculated. I come up to a discount rate for Qualcomm after adjusting for company-specific risk of 11.11%. Their current cash dividend is 2.38%. 5 years ago, they had sales of 22.2 billion or so, and in the most recent year, it was 44.2 billion. That gives them sales growth of 14 to 15% per year for the last 5 years or so. Sorry about that. Sales to capital ratio in the most recent 3 years on average has been 0.85. That's 85 cents in sales for each dollar of capital invested in the business, compared to the industrial average of the last 3 years on average has been 75 cents. So they are more capital efficient than their industrial average for the last 3 years or so. Returns on invested capital for the last 3 years, or actually I think it's the 5-year average, is 18.85%. Debt to equity ratio, actually no, that is the 3-year average now that I think about it. Debt to equity ratio currently 10 to 11%, and default risk pretty negligible, less than 1% or so in the most recent year. Profit margins, they currently have a profit margin of about 34%. And that's an R&D capitalized profit margin. So it does have its own adjustment that we do here, as we talked about, which currently, we did actually discuss that. It currently gives them about 3.5% increase comparative to GAAP earnings or so. And that's comparative to their industrial expectation of the same type of profit margin, R&D adjusted, of 19.5%. So as you can see, they are more capital efficient than their industry, and they are way more profitable than their industry, at least in the most recent year or so. Again, this is kind of a longer term average for their industry. Profit in the most recent year did end up being 15.2 billion, and they're currently selling for $126.02 per share. The probability distribution that we're using across our future assessment of our outcomes is right here, with half of the weight in the third median case model. We also have a little bit of a lean in the fourth, more optimistic model comparative to the second, more pessimistic model. So a little bit of a more optimistic lean in the fundamental assumptions. And that gets us a revenue distribution of anywhere from 43 billion in the worst case scenario to possibly 103 billion in the best case scenario. On expected basis, we see 71 to 72 billion in the 5-year forward period for revenues, which equates to a sales growth of anywhere from negative 0.5% per year for the next 5 years to possibly 18.5% per year for the next 5 years on average. And then on expected basis, we see it being a little over 10% compounded per year. So as you can see, it's a pretty wide range of assumptions for our revenues, which I kind of went over my reasons for why I have it so wide. It is a little bit wider than I would typically like it to be, but the point is that given the cyclicality of their business, there's a pretty wide range of potentialities given what happens in the overall macro environment. But regardless, I feel pretty comfortable with the expected value that we ended up with. The sales capital ratio on expected case, we end up with 92 cents in revenue for each dollar of capital invested in the business. And the returns on invested capital, we end up with about 20 to 21%, which is a decrease from the most recent year, which had pretty insanely high returns on invested capital, but it does increase from their most recent few year average, which is in line with the overall increased profitability given, as we talked about, the lull in the overall cycle. Debt to equity ratio, I do see it increasing on an expected basis up to about 14 to 15%, but given the fact that I'm finding them slightly overvalued, a decent amount of that could just be market cap adjustment and then not really necessarily too much of an issuance of debt. As we've shown here, they don't seem to necessarily have a huge amount of debt relative to their overall liabilities. They keep a relatively clean balance sheet in general. Default risk across the sets of outcomes, I end up with a little over 1% per year on an expected basis, which is nothing too dramatic, pretty typical kind of average level of default risk, nothing too much to be concerned about there. We do end up with a pretty wide distribution of profit margin outcomes, as I kind of talked about, and also justified similarly with my revenue assumptions, which it is pretty a wide range, but really, again, it comes down to thinking more in terms of the expected value, which I was trying to make the expected value be something I'm most reliant on in this. Depending on valuations, worth noting for models that I create, some valuations I actually do rely more on the expected value, and in other valuations I create a set of outcomes and then kind of pick more of a favorite outcome to think more about, and then just think about the differences between the two. And then for my own investment decisions, sometimes I kind of want to rely on one or more of those choices. So in this particular one, I really am just trying to think more about how the expected value is, and just thinking about the different ranges as ways in which the market can reassess its own assumptions about the company itself. But either way, 5 to 35%. Unexpected value, I see about 22%. That gets me a profit distribution of anywhere from 2.1 billion in the worst case scenario to possibly 36 billion in the best case scenario. On expected basis, I see 15 to 16 billion or so in the 5-year forward period. Suvid Vies, keep it up, bro. Thank you very much, man. I appreciate it. So anyway, with those profit distributions and the discount rate that we've applied across the models, that gets us an expected present value of $105.18. which is 16 to 17% higher than the current share price. We have 5-year forward value targets of anywhere from $30.23 in the worst case scenario to possibly $435.38 in the best case scenario. On an expected basis, we see $178.12 per share, which you compare that to the current share price, that gets you an implied return of 7.17% per year for the next 5 years. Again, that's a value targets that's unadjusted for the dividends that would be paid out. So any dividends that would be paid out during the 5-year period would have to be subtracted out of these targets. It's part of the returns. But yeah, 7% per year, not that great of a return. You know, it's a bit overvalued. 11%, which would be the fair value rate, is in and of itself not exactly super enticing for me in particular. But given its space in the market and the way it's related to plenty of other companies and its relationships with them, it's always good and interesting to have this company valued for the watch list. Please repeat about the 5-year target. The 5-year value targets. What these value targets are is basically taking the current fair value, which is what the stock is worth today, and then it's multiplying that by the discount rate for the next 5 years. So it's saying if you buy the stock today, in 5 years time, this is what the stock price will be worth, but it'll also include all the dividends you get, because when you get paid out a dividend, the dividend effectively gets subtracted from the stock price, effectively speaking. It's a give or take thing, a give or take, because the dividends are part of the profit that's not part of the capital appreciation. So if you count both dividends and stock appreciation, then this is what the number is going to end up looking like. Yeah, so that's just kind of, I want to make that clear. It's like, this isn't the stock price in 5 years. This is the stock price plus the dividends from the last 5 years. Yeah, you want to make sure it's the value target, not the price target. So anyway, that's going to do it for the valuation today. Thank you for those who were chatting in the discussion. I appreciate my new viewer there. I don't believe I've seen you in the chat before, so welcome to the stream. Always good to have people commenting below. We always like people to ask the questions as you did, and we're always willing to clarify. So that's going to be it for today. I'm not 100% sure what I'm going to be valuing next for next week. I have been taking a look at a variety of other companies that I want to value, as I kind of talked about on my last stream. I'm kind of keeping my eye out for other 10Ks as they will be releasing in the next month or so. Some of the companies that release their annual reports before the year end, including HP, Sally Beauty, DR Horton Homes, Skyworks Solutions, which should be coming out soon, Ingalls Markets, Valvoline, Starbucks, Visa. So those are the ones that are kind of on my radar. I may or may not cover any or all of those. We'll see what it is, but suggestions are always welcome as well. You can add your suggestions in the comments below, in the chat, or you can join the Discord and share them there and get any feedback on that stuff there. So I'll catch you all again next week, and keep an eye out for the announcement about what the evaluation will be for next week within the next day or two. All right, I'll catch you all again next time. Bye.